idea, right? Because what Markowitz had said, I mean, and he said it 70 years ago about the fact that you really have to look at what you expect a return to be and then discount it by how sure you are that that's going to happen, right? That's variance.
In a nutshell.
And we do, right? We do this all the time in real life. We do it when we choose traffic and we think maybe I'll go that way. It might take 2 minutes longer, but it might avoid the lights, right? We make these trade-offs all the time in our real lives, but we've never thought about doing it in our finances. And that's what he talked about in the 1950s.
That's where it gets me a little, close to cursing, because we don't think about it, but any investor worth their salt does think about it, right? Yep. Like, this is table stakes, okay? Right. So, so let's just look at initially. Well, let me jump over here for a second. This is a spreadsheet that's kind of supplemental to what we've done in RiskSmith so far, right? A lot of this stuff will be coming in RiskSmith.
That's
eventually.
Right. You can think of this as a little preview as to what's coming. So if you're a RiskSmith user and you're watching, these are some things you have to look forward to.
So let me show you some of the highlights of our portfolio since we built it back on February 22nd, right before the invasion. Markets went nuts. And so I think it's been an incredible month to put our technology to the test.
Absolutely.
And the blue line here is the performance of our portfolio since we built it, right? So real time, market tested. And it shows that over this period of time, this portfolio had just less than a 2% drawdown. That was on March 14th, the low of the market, right? The NASDAQ had about a 6% drawdown over that 3-week period or 4-week period, right? So it had the lowest drawdown. And then as of March 22nd, it's beating all of the other benchmarks, okay? This is the gray line is the Dow, the orange line is the S&P 500, and the yellow line is the NASDAQ. Now look, this is a month of performance. I get it, right? It's not a definitive statement, but still very encouraging and exactly what it was designed to do, right? And, people may look at this and go, well, you're at the same place as the NASDAQ, whoop-de-doo. But this is whoop-de-doo when you're at the same place as the NASDAQ and you were down less than, 2% and the NASDAQ was down 6%. That is whoop-de-doo, man. And if people can't see that that is something to get excited about, then they probably shouldn't be investing.
Yes.
Frankly. So very excited about this performance here, right? Got a few other things to look at here. This is the risk efficiency of our portfolio versus the benchmarks over the past month. Okay, so started out about just below 2, and it's actually increased over time, right? And it stayed well above the benchmarks for that whole period. So, and it's not losing ground. It's actually separating itself from the benchmarks more and becoming more risk efficient. Now, I don't expect that to go on forever, but still, it's pretty darn cool.
Yeah, it's a great sign.
And another little nugget here. Okay, so these are like the 5 worst days in the market over the past year. Okay, and these are the 5 best days in the market over the past year.
Yep.
So if we look at the 5 worst days, right, the S&P on March 7th was down almost 3%. The Dow was down 2.4%. NASDAQ down 3.6%. Our portfolio is down 1.9%. And I mean, look at all of these. So I think every single time on the 5 worst days of the market, our portfolio was down the least.
Yep.
Now, when the market was up on its biggest up days, right, we also were not up the most, right? But,
Yep.
even on March 16th, right? That's out of sample, March 9th, right? So we're up 2%, whereas the NASDAQ is up more, 3.8%,
Yep.
down up to S&P 2.24%. So, but we beat the Dow, right? So we're not the last in terms of the upside. We are the best in terms of the downside.
That's right. It's compressing the downside risk, right? It buffers the downside risk, and some of that can or can't tamper the upside as well, but it kind of lets the upside run and kind of keeps the downside from lagging as far. And what I think is so fascinating about this, like if you think about it mathematically, right, and you think about how compound interest works, this is really important to compound interest, which is how you build wealth in the market, right, is compounding. And when you go down and then back up, it's harder to get out of that hole from a compounding standpoint. So if you have a lower floor overall, the compounding math works out better over the long run.
Great
right?
point. And what I love about it is you get to sleep at night.
Absolutely. Absolutely right.
I mean,
you don't go crazy.
I get excited when you talk about your own experience using this, because this is something you've personally wanted to do for a long time, right? And I've seen you now go through multiple market cycles, like drawdowns in the market, and you're like, man, I wish I didn't have to do that, but I'm okay, right? And you've stood your ground.
Stood my ground. That's absolutely right. Before this, and I've said this before, but before we started building RiskSmith, I wasn't really active in the markets. I was not an investor in the markets. I did not invest my own money. I had a financial advisor, just, like the majority of people, right? I shipped it away to some index funds via my financial advisor. But, doing this, building this, we believe in this, and I believe in this. So that I took a bunch of money and put it into a real portfolio about 7 months ago that we built in RiskSmith. And very happy to say that over that 7 months have consistently beat all the indexes that I'm trying to beat, which are the three main ones that we show in the app. And especially when I look through this volatile time, the performance is better, right? Like I'm down since the beginning of the year, but not near as much as the rest of the market. But even more so, it doesn't stress me out. I don't think about it. I check in once a day or so. I say, yeah, everything still looks like it's okay. It's going up and down. That I expect that to happen. And it's allowing me to build wealth in a sustainable way, finally for the first time. And I feel really confident about it. It's wild. It's wild, actually.
Awesome. So wanted to, now that we have an idea of how this has performed, just look a little bit at how it was designed to perform this way and what's driving this performance, okay? And then we can look and see if we want to make any adjustments to the portfolio, all right?
Right.
So there's two things that I think the public is missing out on that we're really bringing to the table here that are driving this performance more than anything else. The first one is the correlation, right? So people think uncorrelated is like a fancy math word, and look, there's some math behind it for sure. But the core idea of having complementary assets in your portfolio that are all going up overall, but that go up, at different times, right? So some are going down while some are going up. That is the biggest thing that I think we're bringing to the table that investors, if they start using this, are going to see a huge difference in their performance. So if we just look here at the covariance matrix, I know it's another one of those fancy multi-syllable math words, but it's just telling you, do things move up and down together, or do they move up and down at different times, right? So Bitcoin, versus Procter and Gamble, okay? They're almost completely uncorrelated, 0.0, slightly negative. But these two, don't go up and down together, right? They're both going up overall, but one's going up while another's going down, and it gives you a smoother ride up the middle, right?
That's what gives you that buffering.
That's where this is
off of the
coming
risk.
from, right?
Yep.
Right.
That's what does it.
That's what does it. And we can look at that day in history, actually. You know, if I go back over to, these are some previews. I've been working on this, Justin. You're not the only designer around here. Let's go back and look at March. What was that we were looking at? 13th, maybe? Or 14th? 13th, I don't see it in here. Maybe that wasn't a market day. Let's look at the 14th. So, yeah, it was March 14th right here. Okay.
Yep.
All right. So what happened on March 14th in the portfolio, right? So here's each stock: Alcoa, AbbVie, Berkshire, Bitcoin, DBA. And you can see, was it down? You know, and this is dollars, right? So $10,000 portfolio. So look, you know, Procter and Gamble was up. Schwab was up, right? These are the benchmarks over here, but Atlassian was down. MongoDB was down. So if we go look at MongoDB and Schwab, you know, I'm going to bet that these might not be that highly correlated. Here's MongoDB and here's Schwab, right? So 0.15, pretty low correlation, right? Again, overall, they're both going up, but they don't go up and down at the same time. And we saw that on the worst day of the market, right? Which was March 14th, right before this huge rally started. Okay. That was the bottom, right? And so that was like Schwab was up, Procter and Gamble was up, Bitcoin was up a little bit. So we had stuff in the portfolio that was going up, even though most everything else was going down. So that's a beautiful thing. So this is so important to understand and to design your portfolio this way. And that's what is going to give you, you know, this smoother ride when everybody else is hitting the bumps.
And this is the difference, right? This is the difference between building a portfolio versus just collecting a bunch of positions, right? Which I feel like what most people do is they collect a bunch of positions in a list, right? It's individual bets. Yeah. This is putting them together in a container so that they work with each other in a very specific way. That's the secret.
And you know, you're really not losing out by limiting your choices in this way, right? How do people end up with that list of stocks, right? Where do those ideas come from? So if you're using Robinhood, for example, they're feeding you those ideas. They're telling you, hey, look over here, right? Look at this. Check this out. Have you seen this? What do you think about this? They're bringing things to your attention. I think it's much more healthy to have things come to your attention because they're uncorrelated to your existing portfolio, right? And we're starting to do that. That should be the criteria for people. So, you know, you can go in here and you can say, hey, let's follow some investors and let's look for ideas that are uncorrelated or minimally correlated, you know, to my existing portfolio. And then let's choose from these ideas, right?
Yeah.
So that's not taking away any freedom, right?
Right.
That's not like,
if anything, it's giving you more freedom, right? Because now instead of thinking that you need to invest in whatever I'm reading about on the front page of Bloomberg or whichever financial press it is, now you actually have the entire world of assets available to you. And so many more will be great investments than you think because they'll work together in a portfolio well. And it actually is a freeing thing more than it is constraining, I feel like.
Absolutely. Totally agree. So, you know, hey, I don't know, let's try Apple in here and see what happens.
Yeah.
Drum roll, please.
I think it's going to be interesting it's going to be interesting to see, you know, oh, look at that. Apple it actually didn't help that much. Pulled the risk efficiency down 0.02 of a point. dScore went up 0.02%.
Didn't hurt.
Kept it. It may have, did not hurt. And it probably, one of the great things about this also is, right, like you can add an asset like this into the portfolio and it may leave the numbers close to the same where they were, even the growth number, but you have another asset yet that is, again, uncorrelated with the other items. So it's still providing more of that buffering effect, even though like it didn't have a performance enhancement in terms of just the absolute numbers, right?
All right. So we've talked about the correlation and building your portfolio with minimally correlated assets, right? You can't get everything to be perfectly uncorrelated. And you don't really want negatively correlated because you want things that are all going up overall, right? So we've done a pretty darn good job in this portfolio, I would say.
Yeah, this one's looking pretty
good.
My personal portfolio could learn a little bit from this one.
All right. So the other piece here that's really driving that performance is what's called position sizing. Okay. And I love how these histograms, just at a glance, give us a sense, like, is this a investment with a lot of possible future paths, right? Or is it an investment with a more narrow set of future paths, right? So here on the top row, we've got, 3 good examples: AbbVie, Alcoa, Procter and Gamble, right? So AbbVie, it's got a, actually we can go look at it a little more closely, right? It's got some days that are down 2.5%, up 2.5%. So a little bit of a spread there, but nothing like Alcoa, right? Where you got these, minus 5% days, lots of plus 5% days. Gotta love that, up 213% in the past year.
Wow.
Okay. But, and then Procter and Gamble here, right? It's got the tightest, most compact histogram of the 3. Almost everything's, I'd say 98% is between minus 1.5 and plus 1.5% on any given day, right? So, and then like Alcoa has a lot of possible future paths, right? So we're putting less money into Alcoa, 3.4%, right? Yeah, it's up, 213%, right? But only 3.5% of the capital is in that position. So you're getting, a lot of bang for the buck for that 3.5%, but you're not putting so much into Alcoa that it spreads out your whole portfolio histogram. I mean, the portfolio histogram for this is pretty amazing. Right here.
It really is. It is so tight.
There is one day of, 2%. More than 2%, but there might be one day of minus 2%, but
any days,
the maximum down day has been like minus 1.5%.
Right. I mean, it really is a beautiful histogram.
Even though, MongoDB over here has had plenty of days where it was down more than 5%, right? But only 3% of the portfolio is in that position.
Yeah.
Right?
Yep. And this is what Markowitz was getting at, right? Which is the wider the histogram is, the more you have to discount what you think it will do in the future because you can't count on it, right? And so it is kind of, it's worth less in the future than something else that's more predictable would be.
Absolutely. And if we look at MongoDB, it's got a lot of more slightly negative correlations, but still all of them are about 0.0.
Yeah.
It'd be interesting to see what happens if we took Mongo out of the portfolio. I think that might be one change that I would consider.
Could be interesting to see what happens. Yeah.
I know we both personally like their services, right?
Yep.
But let's see what happens if we take Mongo out of the portfolio.
Right. And just because I like a player on my fantasy football team, doesn't mean that they're going to play every game, right?
Right. So we got 3.63 and 1.16. Let's take Mongo out. Recompute.
Yep. Yeah, and
Did it have no impact?
Oh yeah, no. Well, It should have.
Do a refresh.
Yeah, that's maybe a little network congestion with the Skype call or something that dropped a packet. I've actually never seen that happen. That's the first time I've ever seen it not automatically update when you've pulled a position out. Yeah, it's really interesting. And when you're thinking about the hurricane metaphor for just a second, this just occurred to me that if you think about about hurricanes, you think about the kind of cone of uncertainty, as it were, right? And that's all that's all histogram is showing the cone of uncertainty, right? And if you think about it, a hurricane that has a wider cone of uncertainty very well, or it actually makes the whole thing more expensive. It makes it more costly because now you have a lot more people preparing for this outcome. You have a lot more people trying to, spending money trying to prep for it. And overall, it makes the thing more costly because of its lack of predictability. And cost ends up taking away from gains, right? And so that's exactly what's happening here as well. Is that not loading? Why is that?
It's not loading. We're not loading on a live stream.
I know.
Jay.
I know. I'm curious.
This is why we're in beta.
Because
I
think it may be actually a connection issue on your end because it's loading great for me. So it just could be a little network congestion on your machine.
You have the live stream up on your?
I don't, but if you make it, I can put it up if you want me to.
Let me just look at it in another browser.
Yeah. Could just sometimes the network can cause issues. But if you just send me the link to it, I will pull it up here. And that's the great thing about these being shareable, right? Is that Richard can just send me that link, and even though his machine is struggling a little bit right now, I'll be able to bring it up.
Let's see, where are you? There you go.
There we go. Perfect. And I will grab that, and I'll take over for you. And you just tell me what you want. Now, the only problem is I'm not going to be able to add and remove to this because it's a public shared portfolio that I can only see it. I can't work on it.
That's okay. Actually, why don't we look at your portfolio for a minute?
All right. Yeah, great.
While that one's loading.
Yeah, let's take a look. Let's take a look here. Let me just find out how to share my screen. Jacques, how you doing? It's great to see you. Thanks for giving us a shout out there on the chat. If there's anything anybody has a question about, you want to talk about or anything like that, just let us know. So this is my portfolio. And one thing, can you see this okay?
Yep.
Great. So one thing about if I was going to look for areas of improvement, let's talk about where I might change some things, because I've been doing really well over the past few months, right? But I still know that there are probably some areas where I could improve, and I'm going to show you a couple of those areas. One of them is that I've only got 6 positions here, right? It's not a lot. We'd really like to get up to a little bit more than that because, again, the more positions we have working together, the more chance we get of that dampening effect from the lack of correlation, and overall we get a smoother ride, right?
Yep.
And that would probably pull this histogram in. So if I were, say, to take something like this TMAC here, which is, how is TMAC doing? Okay. Oh, that must be like a. Sometimes you'll see these. These are kind of these special acquisition companies, or this is just a new one, I guess. Sometimes you'll see a SPAC. It'll look like that. Let's add TMAC in here. And so that actually did not help out my portfolio at all. Great. But either way, I think I can tighten this up. The other thing that is that I'm noticing is that my covariance matrix is a little brighter than I would like it to look. There's a little bit more correlation here than I'd like to see. I've gotten away with it for a little while, but this is the one thing that kind of doesn't keep me up at night, doesn't make me nervous, but it does. Yep. I think about it as an area of improvement. As you can see, US oil here is very highly uncorrelated to nearly everything that I've got, except for Alcoa, which kind of makes sense. They're both in
or commodities,
Yep, commodity.
Materials.
Yep, exactly. So those are a couple things that I think that I would like to change in that. All right, so let's go back. I think there may be. Can you do me a favor? If you go back to this share portfolio for me, Ryan, one of our stellar developers who is on the line here, he said, "See what happens if you pull Bitcoin out of the portfolio. That for whatever reason could be choking for just right now. So if you pull that out of that, it may start to work. I'd be curious actually to see how pulling Bitcoin out of that portfolio changes things."
Oh my God! And let me get back on.
Yeah.
Sharing my screen now.
Yeah.
Because that did do it.
Okay.
A fortuitous adjustment, because now the risk efficiency is almost 4, and the dScore is less than 1%.
Wow.
That's crazy. So that's without MongoDB and without Bitcoin.
Wow.
Now, I think this brings up an interesting point, because just because an asset does lower the risk efficiency or the dScore, okay, that is because of its past performance. So if you have strong conviction that future performance is going to be significantly different than past performance, that can be a justification for accepting something in your portfolio that does lower your risk efficiency a little bit, because you think that its future performance is likely to be different than its past performance. Now, that can be a very dangerous assumption. But with Bitcoin, I do believe that its future performance is going to be more likely to be positive than negative.
Yep.
And I think it's rightfully corrected over the past year. And I personally have some anecdotal reason to believe that Bitcoin is pretty strong where it's at right now, and is likely to rise, for the next few months.
Yep.
So I might accept it in my portfolio, even though it brings down my risk efficiency and my dScore. But still, those are some pretty compelling numbers that we're looking at on the screen right now.
Yeah, boy,
by taking out MongoDB and Bitcoin, which were small positions, right? They were only each 3% of the portfolio.
Right.
But
yeah,
I gotta say,
one of the things that we look at,
as good as it gets right there.
Yeah. Oh, absolutely. One of the things that we look at internally and we talk about, and actually this may show up in the product soon, because I think that this is a useful derivative off of these values, is that spread between risk efficiency and dScore. Really, the spread between those two numbers, the higher you get risk efficiency and the lower you get dScore, and the spread between those, everything else being equal, is really your target, right? That's really the way to juice this and to get the most well-performing non-volatile thing on the way up. Now, where was I going to go? Oh yeah, and so what I was going to say, sorry, I lost my train of thought for a second. What I was going to say is that this spread between almost a 4 risk efficiency and less than a 1 dScore is actually, I think, in the history of working on this thing and we've looked at thousands of portfolios at this point, I think that's the biggest spread I've ever seen, to be honest with you.
Yeah.
That's really impressive.
Let's see what happens if we make this an equally weighted portfolio. Right? Risk efficiency goes down, dScore goes up.
This is a case study right here in what position sizing does for your portfolio.
Absolutely. Well, folks.
Hey, Ryan had a question. Ryan asked what the growth was on that. What's the growth on that, Ben? With that kind of spread over the last year, still made 34.59% over the past year.
And you can see, your growth versus your volatility, right? Or your standard deviation, right? So this is pretty darn low.
Yep.
So what is this telling us? This is one standard deviation means about 65%. So 65% of the time, your portfolio is within 0.6% plus, 0.6% in any given day, right? So that means most of your daily returns, and it's exactly what you see in the histogram, are falling in these two, minus 0.5% plus 0.5%.
Yep.
Right?
Yep.
Slightly over, to get 65% of them, you got to get over into the 0.5 to 1, right?
Mm-hmm.
And minus 0.5 to minus 1. But that's what it's telling us, that 65% of our daily returns have fallen within this center part of the histogram, right? And that's exactly what you're seeing there. So growth is going up, volatility is holding steady, right?
Yep.
Standard deviation's holding steady. Hence, risk efficiency is headed
up
sky high.
Yep.
Right?
It's a beautiful portfolio. It really is.
Beautiful portfolio.
We built this in 20 minutes a month ago.
Yeah. So I don't think we can do a whole lot better than that. Let's take a quick look at the covariance matrix, see if there's anything else. Oh, one other thing. I made this chart. This is the individual components, okay? And over the past year, kind of what they started at dollar-wise and where they're at today, right?
Okay.
So we can look at this and see if there's anything that's, really not, well, I mean, I think if you look at all of them, the first thing is they're pretty much all going up, right? So
yep.
I'm trying to see if any of them are like lower 1 year later today than they were, I guess, Bitcoin, right? So not surprising taking that one out of the portfolio.
Yep.
I just have an emotional attachment to Bitcoin, I guess.
Which again, like you said, you can invest.
And look, there's the other one, MongoDB. Right?
Oh yeah.
Those are the two that over the past year haven't proven their mettle.
Nope.
Right?
Nope.
Take them out of the portfolio and no surprise.
Yep.
Risk efficiency goes up, dScore goes down.
And I think we've got a good one here to watch for another month and see how she performs. What do you think?
I think so.
Love it.
All right. Well, just circling back, summing up, you can look at these histograms like spaghetti plots. The more spread out it is, right, there's a cost to that spread. That's essentially what Markowitz was telling us. If like these are your possible paths or these are your possible paths, right? Each of these possible paths is going to, be less valuable than a tighter set of possible paths. Harder to predict. That's the variance. Expected return good, variance of expected return bad.
Yep.
Now, we believe that it's good to have some spice in your portfolio, to go along with your meat and potatoes and vegetables. Or forgive me if you're a vegan, but you don't want a whole meal out of salt and pepper and spice.
Yep, that's right.
So this is pretty darn balanced portfolio. Man, I like it.
I love it. I'm into it. I can't wait to see how this fares.
Right. So a little less money in the things that are more spread out, like Ford, oil. More money in the things that are the tightest. Like what's the tightest in here? Probably gold, 16.5% of the portfolio.
Yeah.
So there you go.
All about Procter & Gamble. Yep. Excellent stuff.
All right.
We'll see how it does for another month. But hopefully, if you're watching out there, this gives you an idea about how you can use the tool and you can put together your own portfolio. And look, there are millions and millions of great portfolios out there. So just find the one that is right for you and go build it and go start making money.
Hey, every time I use it, I just want to say thanks again for building such a killer, usable product.
The thanks goes both ways because it's your market experience over 20 years and insights that have led to this. And it's great stuff. We have a bright future.
Awesome. All right. Have a good one. Bye.